$1 million has become the universal retirement number for a reason. People can argue about whether it is enough, whether inflation will change the target, or whether retirement should ever be reduced to one clean figure. But when ordinary people first begin thinking seriously about financial independence, $1 million is usually the number they reach for. The more important question is not whether $1 million sounds impressive. The more important question is what it takes to get there from zero. Most people guess badly. Some assume it requires an impossible amount of money every day, so they never begin. Others assume a small contribution and a little optimism will be enough, so they underestimate the work required. The real answer depends on one variable more than almost anything else. Time is the cheapest source of retirement money in the world. If you give compounding enough years, the market can do most of the work for you. If you refuse to give it years, then you must replace lost time with much larger contributions, much higher risk, or both. That is the whole system. The destination can be the same. The path can be completely different. So I want to walk through three paths to the same $1 million finish line. One path takes 30 years, one takes 20 years, one takes 10 years. All three begin at zero. All three use the same three Fidelity funds. All three end at roughly the same destination. But what each path demands from the investor is radically different. And when you see the three side by side, you understand something very important about money. You are not only investing dollars, you are investing time. Before we get into the daily contribution numbers, begin with the destination itself. Why $1 million? Because $1 million is large enough to begin producing income that can meaningfully replace work. There is a retirement strategy often called the 4% rule. The idea is simple. If a person retires with $1 million invested in a diversified portfolio, that person can withdraw 4% in the first year of retirement, which is $40,000. Then in later years, that withdrawal can be adjusted for inflation. The basic logic is that over long periods, a properly invested portfolio has historically grown faster than 4%, so the retiree can take income while the capital continues working in the background. The 4% rule is not a guarantee. Markets do not rise every year. Inflation is not constant. Sequence of returns matters. But as a planning framework, it explains why $1 million became such a powerful milestone. $40,000 per year is about $3,333 per month at an average Social Security benefit, and the monthly retirement income can rise above $5,000. That may not be luxury, but for many people it is the difference between dependence and autonomy. It is money arriving even when they no longer sell their time. That is what retirement assets are supposed to do. They convert past discipline into future cash flow. Now imagine John. John begins with nothing saved for retirement, no inherited portfolio, no brokerage account, no windfall. A normal job, a normal income, and until recently, a vague belief that retirement was something that happened to other people. Then he runs the numbers, he sees the $1 million destination, he understands what that destination could produce. And then he faces the real question, how much must he invest every day to get there? The answer depends almost entirely on how much time he is willing to give the machine. No matter which timeline he chooses, he uses the same three Fidelity funds. The first is FSAX, the Fidelity 500 Index Fund. This is the broadest and most boring piece of the system, which is one reason it works. FSA tracks the SP 500, giving John exposure to the largest companies in the United States. When he buys it, he is not betting on one company, he is buying a slice of the American business system. The expense ratio is around 0.02%, almost as close to free as investing gets. Over the last decade in the source example, the fund averaged about 12.97% in annual share price appreciation. This is the foundation. The second fund is FNCMX, the Fidelity NASDAQ Composite Index Fund. This fund brings more growth and more volatility. It tracks the NASDAQ Composite, which leans more heavily toward technology, biotech, and companies that can grow faster but also swing harder. Over the last decade in the source example, FNCMX averaged about 16.91% in annual appreciation. This is the bridge between broad market stability and aggressive growth. The third fund is FELX, the semiconductor fund in the source example. This is the most aggressive component. It focuses on the chip makers behind phones, laptops, data centers, and AI. Over the last decade in the source example, it averaged about 22.04% in annual appreciation. That is the engine that makes the 10-year version mathematically possible. It is also the riskiest fund in the portfolio. Semiconductors are cyclical. When they fall, they can fall hard. That is why the weighting of this fund changes so dramatically across the three plans. The funds stay the same. The allocation changes because the timeline changes. That is the first major lesson. Portfolio design is not only about what you buy, it is about what your timeline requires. If you have 30 years, you can let stability and compounding do more of the work. If you have 10 years, you must demand more speed from the portfolio, and speed usually comes with more concentration and more risk. Now begin with the easiest version, 30 years. This is the version in which time works hardest for John, because he gives compounding 3 full decades. He does not need to force the portfolio into extreme risk. The allocation is simple: 60% in FXA, 30% in FNCMX, 10% in FELX. The broad market does the heavy lifting, the NASDAQ adds growth. The semiconductor fund gives a small boost without dominating the system blended together. This portfolio has a dividend yield around 0.81%, dividend growth around 6.18%, and annual share price appreciation a little above 15%. In the source example, the yield is modest, but over 30 years it does not need to be large. The real force is time. Now comes the number most people do not expect: to reach roughly $1 million in 30 years under these assumptions. John needs to invest about $6 a day, $6 about the cost of breakfast. That amount sounds almost too small to matter, which is why it teaches the lesson so clearly. The contribution is not extraordinary. The time horizon is at the end of year 1. John has about $2,190, essentially what he put in at year 10. The account is projected around $45,641 at year 20, around $234,158. By year 30, the account reaches roughly $1,004,150. That is the retirement destination from $6 a day. But look at what built the final number. John personally contributed only $65,700 over 30 years. The market contributed roughly $938,450. This is what long-time horizons do. They make the investor's own contribution small relative to the final outcome. In the 30-year plan, John is not doing most of the wealth creation. He is simply showing up consistently and giving compounding enough time to dominate the result. This is the cheapest version of retirement. Not because waiting 30 years is emotionally easy, it is not. But financially, time is doing the heavy labor. The person who starts early is buying freedom at the lowest daily price. Now move to the 20-year version. The destination remains the same, the funds remain the same, but John removes 10 years from the machine. That lost decade has to be replaced by something: higher contributions, higher growth exposure, or both. So the allocation shifts. FXA falls from 60% to 35%. FNCMX rises to 40% and becomes the largest component. FELX rises from 10% to 25%. The broad market is still present, but growth now carries more of the burden. The new portfolio has a blended dividend yield around 0.58%, dividend growth around 5.16%, and annual share price appreciation around 16.81%. The yield falls, the volatility rises, the growth estimate climbs. That is the trade John is making. He has less time, so the portfolio must work faster. Now the daily contribution is no longer $6. It is $22 a day, about $660 a month. About $8,030 a year. That is still doable for many people, but it is no longer casual. It requires priorities, maybe fewer restaurant meals, maybe a smaller car payment, maybe less lifestyle inflation, maybe a budget that proves retirement is more important than convenience. By the end of year 1, the account is roughly $8,030 by year 10, around $180,684 by year 20. The account reaches approximately $1,040,920. Again, he gets there. But the internal economics are different in the 30-year plan. John contributes $65,700. In the 20-year plan, he contributes $160,600. He bought back 10 years of time. The price was almost $95,000 more from his own paycheck. That is the part people miss. Waiting is not free. If you do not pay early with time, you pay later with money. The market still does most of the work in the 20-year plan. But John now has to do much more of it himself. Time is still helping him. It is just helping less. Now we reach the version most people click to see: the 10-year path. The dream of going from $0 to $1 million in only a decade. This is where people often become unrealistic because they hear the destination and ignore the cost. 10 years is a very short runway for compounding. If John wants $1 million in that period, he cannot rely on a broad market heavy portfolio and a small daily contribution. The math will not allow it. He needs far more aggressive exposure and far more capital from his own pocket. So the allocation shifts again. FXAGE drops to 15%, FNCMX sits at 35%, FELX rises to 50%. Half the portfolio is now concentrated in semiconductors. That is not broad diversification, that is a large sector bet. The reason is not that concentration is automatically better. The reason is that with only 10 years, John needs a return profile the broad market alone is unlikely to provide. The portfolio's blended dividend yield falls to roughly 0.34%. Dividend growth falls to around 3.44%. Annual share price appreciation rises to about 18.88% in the source example. This portfolio is not built primarily for stability, it is built for speed, and speed demands payment. The required contribution is $120 a day, $43,800 a year, about $3,650 a month, every month for 10 years. This is not a realistic plan for everyone. It likely requires a household income around $120,000 or more after ordinary living costs are considered. If that is not your reality, the answer is not shame. The answer is arithmetic. The 20-year plan or the 30-year plan may fit your life better. That is not a downgrade. That is choosing a system you can actually execute. At the end of year one, John has about $43,800, almost all from his own contributions because the market has not had enough time to do much. By year 5, the account is projected around $320,168. By year 10, the account reaches about $1,083,063. He reaches the same destination, but again, the composition tells the real story. John personally contributes $438,000. The market adds roughly $645,063. The market still does more work than John, but only barely. In the 30-year plan, the market gives him almost $14 for every dollar he contributes. In the 20-year plan, the market gives him about $5.50 for every dollar. In the 10-year plan, the market gives him only about $1.50 for every dollar. That is the whole lesson. The destination is the same, the cost structure is not. Time is the cheapest retirement funding source available. Remove time, and you must replace it with money. Remove more time, and you must replace it with money, concentration, and risk. People often ask which portfolio is best. That is the wrong first question. The better question is which portfolio matches reality. If you are young and have 30 years, the $6 a day version is extraordinarily efficient. If you still have 20 years, the $22 a day version may be demanding but realistic. If you want to compress the journey into 10 years, then you need to understand that you are not relying mainly on compounding anymore. You are financing much more of the result yourself. That is not bad, but it is different. The 10-year version does not prove that anyone can retire quickly if they simply want it badly enough. It proves that speed has a price. This is how systems work. Every outcome has inputs. If the output is $1 million, the inputs are contribution, return, and time. You can change the mix. You cannot escape the equation. Most people make financial decisions as if time is abstract. They say, I will start later. They say, I will invest more when I earn more. They say, I will catch up. Sometimes they can, but catching up is expensive. The 30-year investor pays $6 a day. The 20-year investor pays $22 a day. The 10-year investor pays $120 a day. Same finish line. Wildly different daily burden. That is the cost of delay. The person who starts early looks lucky later. He is not lucky. He bought more time when time was cheap. That is why one of the most dangerous financial phrases is, I still have time. People usually say it while the most valuable form of time is quietly disappearing. Early years are not equal to later years in compounding. A dollar invested early has decades to reproduce. A dollar invested late has to work much harder. If you wait until urgency appears, the math becomes severe. That does not mean late starters are doomed. They are not. The 20-year and 10-year plans show that meaningful wealth can still be built later. But the path becomes more demanding. You must save more. You may need more income. You may need to accept more volatility. You may need to reduce lifestyle. You may need to become much more intentional. The system will still work, but it will ask more from you. There is another lesson inside the allocations. Risk should be related to time. In the 30-year portfolio, broad market exposure dominates because John has enough years for ordinary market compounding to work. In the 20-year portfolio, growth exposure rises because the runway is shorter. In the 10-year portfolio, the semiconductor fund becomes half the portfolio because the plan needs aggressive returns to have a chance. But aggressive returns do not arrive without aggressive volatility. Semiconductors are cyclical. They can boom, they can crash. If John uses a 10-year plan, he must be able to hold through that volatility without abandoning the portfolio at the wrong time. That is crucial. A portfolio that is mathematically capable of reaching the goal is useless. If the investor cannot hold it emotionally, the highest return portfolio is not automatically the best portfolio. The best portfolio is the one you can fund and hold. Now look at the three plans another way. In the 30-year version, John's contributions are small relative to the ending value. The machine has a long runway. The early dollars spend decades producing growth on growth. By the later years, the portfolio itself is doing almost everything. In the 20-year version, compounding still works, but it receives less time. John must add more fuel in the 10-year version. The machine has very little runway. The contributions dominate early. John is almost building the account directly with his paycheck while asking the market to accelerate the result. This is why the first years look so different. At year one in the 30-year plan, the balance is only a little above $2,000 at year one in the 10-year plan. It is over $43,000. But the larger early balance is not because compounding suddenly became magical. It is because John is putting in far more money. That distinction matters. Some people confuse high contributions with investment brilliance. If you contribute huge amounts, the account grows faster. The deeper question is how much of the final wealth came from your labor, and how much came from capital working for you. That is where time reveals its value. Now, $1 million itself is not sacred. For some people, it may be enough. For others, it may not. Location matters, lifestyle matters, health costs matter, taxes matter, debt matters, inflation matters. A better plan begins with the income you need in retirement, then works backward to the capital required. Still, $1 million is a useful teaching number because it makes the trade-offs visible. If John wants $40,000 per year from the portfolio, the 4% rule points toward $1 million. If he wants more income, he needs a larger target. The exact destination can change. The principle does not. The more time you give compounding, the less of your own paycheck has to fund the result. The less time you give compounding, the more the burden shifts back onto you. There is also a danger in assuming past returns will repeat perfectly. The source uses historical appreciation rates near 13%, 17%, and 22% for the three funds. Those numbers help illustrate the math. They are not promises. Future returns may be lower. A decade that favored technology and semiconductors may not repeat exactly. If returns disappoint, the 10-year plan becomes much harder. The 30-year plan has more room for bad periods because time gives the portfolio more chances to recover. The 10-year plan is more fragile. If a semiconductor-heavy portfolio suffers a major decline late in the journey, there may not be enough time to repair the damage before the target date. That is another price of compression. Short timelines increase sequence risk. Long timelines are more forgiving. Time is not only cheaper, it is safer. So what should John do? He should not choose the most impressive plan. He should choose the plan he can actually execute if he is young. The $6 a day plan may be the wisest because it lets time become his greatest partner. If he has 20 years, the $22 a day plan may fit. If he truly wants to compress the journey into 10 years, he must be honest about whether he has the income, discipline, and risk tolerance to invest $120 a day into a much more volatile portfolio. There is no shame in choosing a longer path. A plan that looks ambitious and fails is worse than a plan that looks ordinary and works. Durability matters more than excitement. The financial world loves dramatic promises. Retire in 10 years, turn 0 into 1 million, get rich fast, but every fast plan has a hidden requirement. More income, more savings, more risk, more concentration, more sacrifice. When those inputs are made clear, the fantasy becomes a system. Then a rational person can decide whether it truly fits. People often focus only on the final number, 1 million, 1 million, 1 million. But the path tells the deeper story in the 30-year version. John contributes about $65,700. In the 20-year version, he contributes about $160,600. In the 10-year version, he contributes $438,000, almost 7 times the 30-year amount. Same destination, very different personal cost. That is why starting matters so much. You can make more money later, you can change jobs later, you can save more later. But you cannot go back and invest $6 a day 30 years earlier once those years are gone. Every early contribution buys future compounding at a discount. The person who starts young is not merely saving more years. He is renting the market for longer. That is one of the best deals available in finance. The 30-year plan is mathematically easiest and psychologically hardest to begin. When people are young, retirement feels distant. $6 a day feels optional. Urgency is low. The first-year balance looks unimpressive, so people delay. Then 20 years later, the daily requirement is larger. Delay charges interest. You do not see the bill immediately. You see it later in the form of much higher monthly sacrifice. That is why young people should understand this comparison early. If you start now, time carries more of the load. If you wait, your future self carries more of it. Income also matters. The 30-year plan can fit many incomes because $6 a day is small. The 20-year plan demands more intentionality. The 10-year plan requires a very large surplus. If someone wants to go from 0 to 1 million in 10 years, the problem is no longer only investing. It is income. $3,650 a month usually requires strong earning power, not just cutting a few expenses. That is another reason early investing is so valuable. It reduces the amount future income must divert toward retirement. The 10-year portfolio also reveals something about concentration. Half the assets are in semiconductors. That is not classic diversification. It is a growth bet. Concentration can create extraordinary returns. It can also create extraordinary disappointment. If you need a precise amount by a precise date, depending heavily on one volatile sector makes the system less robust. The faster you want wealth, the more tempting it becomes to concentrate. The more concentrated the portfolio, the fewer ways the plan can succeed. That is why speed and fragility often travel together. Now, the portfolios in this example are built backward from a target using historical assumptions. That is useful for learning. But real investing happens forward. Past returns are not guaranteed. Inflation may change what $1 million buys. Future valuations may be different. So treat the numbers as a framework, not a promise. The framework is still valuable because it teaches one of the most important relationships in personal finance. You can reach the same destination with less money if you start earlier, or with more money if you start later, but you cannot escape the trade-off. Do not only ask how much you need, ask by when. Do not only ask what fund has the highest return, ask how much risk your timeline requires. Do not only ask whether a contribution feels small, ask how many decades it can compound. Do not only ask whether a 10-year plan sounds exciting, ask whether you can fund it and survive its volatility. 30 years means $6 a day and a portfolio tilted toward broad market growth. 20 years means $22 a day and more growth exposure. 10 years means $120 a day and a highly aggressive portfolio. 3 paths, same finish line, different cost, different risk, different lifestyle burden, different psychological demand. That is why retirement planning must be honest. People do not fail only because they choose bad funds. They fail because they choose plans that do not fit their lives. A realistic plan executed for years beats an exciting plan abandoned after 6 months. Now ask yourself which John you are becoming. The John who begins early and lets $6 a day compound for 30 years. The John who waits and later must invest $22 a day. Or the John who delays so long that $120 a day becomes necessary to reach the same place. The right answer depends on where you are now, but the principle is the same for everyone. The best day to give compounding more time is the earliest day still available. You cannot recover yesterday. You can still use today if you begin. Now, even with a small amount, time starts working. If you keep waiting, future you receives the bill. That is the real lesson behind these $1 million portfolios. Not that Fidelity has a magic fund, not that semiconductors guarantee retirement in 10 years, not that anyone can escape arithmetic. The lesson is that time is the quiet partner in every fortune. The earlier you hire it, the less expensive your future becomes. The later you hire it, the more of the work you must do yourself. 30 years lets the market contribute almost everything. 20 years still gives you powerful help. 10 years makes you pay heavily for the time you did not give it. So choose deliberately. Do not choose based on fantasy. Do not choose based on what sounds impressive. Choose the path you can fund, execute, and hold through volatility. Then begin. Because the $1 million destination is not reached by admiring the math. It is reached by putting the first dollar to work while time is still cheap.